do you feel about trading in prolonged market trends? Have you ever considered holding on to a trading position for weeks or even months to maximize profits? Well, today we will discuss about position trading. Hi friends, before we start this lesson, subscribe to our channel and hit the notification button so that you don't miss our videos on Forex trading. So what exactly is position trading? Position trading is like a long-distance relationship. You hope that it works out, but most of the time it's just a lot of waiting and wondering if it's worth the effort. Well, it's not exactly like that. Position trading, my friends, is more than just a strategy. Position trading is a methodical approach in which traders capitalize on prolonged market trends. Unlike short-term strategies, position trading involves holding on to a trading position for an extended period, typically spanning weeks or even months, to maximize profits. Sounds intriguing, right? Now, the core principle of position trading is fascinating. At its core, position trading operates on the belief that the selected trading instrument will experience significant growth over the long term. This principle guides traders to focus less on day-to-day price fluctuations and breaking news, emphasizing a broader, long-term perspective of the market. One notable characteristic of position trading is its versatility. This strategy can be applied to various CFD instruments, including stocks, bonds, commodities, and indices. The success of position trading hinges on a thorough analysis of market trends, direction, and the expected duration of the position. Position traders adopt a patient and strategic approach. They're less swayed by short-term market volatility and remain committed to their long-term vision. By navigating through the waves of the market, position traders aim to anticipate and benefit from significant moves within the overarching trend. Now, I know what you might be thinking, isn't position trading just long-term investing under a different name? Not quite. Let's break it down. Position trading and long-term investing. It's like choosing between a microwave and a slow cooker. One gives you instant regret, the other slow-cooked remorse. I'm just kidding, guys. Let's get back to the serious stuff. First difference between position trading and long-term investment is that long-term investing often involves buying and holding assets with a set-it-and-forget-it mentality. Position trading, on the other hand, requires a more active approach, with traders regularly assessing market conditions and adjusting their positions accordingly. Second difference. Position traders thrive on short to medium-term market fluctuations, leveraging both rising and falling trends to maximize profits. Now that we've got the basics covered, let's explore the types of position trading. Position trading is of four main types: long, short, neutral, and mixed. Each offers a unique approach to conquering the markets. Let's explore these types. First on our list is long position trading. Imagine setting your sights on a trading instrument, believing it's destined for greatness. Long position traders are bullish, buying and holding with the expectation that the price will appreciate over time. It's like planting seeds, patiently waiting for them to grow into a profitable garden. Now, let's talk about the flip side, short position trading. In short position, traders take a pessimistic stance, expecting a trading instrument's value to decline. They take a short position for an asset and maintain the position over an extended period. For instance, a short position trader might short a company's stock CFD with poor fundamentals, anticipating a decrease in value over weeks or months until reaching a target price or observing signs of strength again. Next up is neutral position trading. Neutral position traders adopt a patient approach, holding on to a trading instrument without a clear bias on its future direction. They believe the asset will fluctuate within a certain range over time. For instance, a neutral position trader may engage in buying and selling CFD with moderate growth and low volatility, maintaining these positions for weeks or months until significant changes in market conditions or the instrument's performance occur. And now the versatile mixed position trading. Mixed position traders are versatile and seek to diversify their portfolios by holding both long and short positions on various trading instruments for an extended period. This strategy aims to hedge against risks and capitalize on market trends and cycles. For instance, a trader with a mixed position might trade the stock CFD of a company with robust growth potential in a thriving industry, while simultaneously selling the CFD stock of a company with feeble growth potential in a declining industry. These positions are held for months or until a reversal in market trends or sector performance is observed. Excited to get started with position trading? Let's talk about how to put this strategy into action. Position trading is like sending a text to your crush. You hit send, wait anxiously, and when you finally get a response, it's just a K from the market. Well, it's just a joke, and we have already understood how beneficial position trading can be. Now let's understand some common position trading strategies that these traders leverage for success. First on our list is the carry trade. In the Forex market, it's the go-to for predicting long-term currency pair movements. Imagine borrowing money in a currency with low interest rates and investing it where rates are high. The goal? Profit from the difference in interest rates. It's a bit like borrowing in Japanese yen and investing in American dollars when the interest rate differentials are in your favor. Traders often base long-term decisions on forecasts of interest rate hikes. Next up, we have trend following. This strategy involves riding the wave of market trends, entering and exiting trades based on signs of acceleration or deceleration. Trend followers use indicators like moving averages, MACD, and RSI to measure and spot potential entry and exit points. Then there's contrarian trading, going against the market sentiment. Contrarians enter and exit trades when prices show signs of overbought or oversold conditions. Indicators like Bollinger Bands, Stochastic, and CCI help gauge sentiment and identify possible entry and exit positions. Another favorite in the position trader's toolkit is the 50-day and 200-day moving average strategy. By combining these indicators on a price chart, traders seek opportunities when the two averages cross over. For example, a crossover where the 50-day moving average goes above the 200-day is seen as bullish, signaling a buy. Conversely, a crossover where the 50-day goes below the 200-day is considered bearish, signaling a sell. That's a wrap of our video on position trading. See you next time.